This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello, Robert Kiyosaki, the Rich Dad Radio Show. And this is kind of a bonus program today. And the reason it's a bonus is just going to be me. You don't have anybody else to listen to or talk to. And I'm just going to share with you kind of my concerns today. And again, we're a financial education show. And a lot of times we have people either talking about real estate or talking about crypto, or they're talking about stocks or trading. And I'm going to give you a little bit more of a macro view, a bigger picture on it. And I'll tell you why. So this is kind of a bonus Rich Dad show, and to thank you for being a loyal subscriber and listener to the Rich Dad program, because all we are is financial education. We sell things like cash flow games and books and tapes, but we really want you to be educated. So I'm going to tell you why this little bonus program comes in. As the other day I was at the gym, and this gentleman comes up to me, and he was really proud. He says, "I've been a bus driver for the city of Phoenix for 40-something years, and I'm going to retire." And I said, "Oh, I said, I don't know anything about government employees." And I said, "Is the government giving you a retirement?" So years ago, when I was a kid, before 1974, there was a thing called a defined benefit pension plan. Defined benefit meant they guaranteed you X amount. So my poor dad, if he retired, he lost his pension too, which is this book here, Who Stole My Pension? This book just came out, Who Stole My Pension, because it's going to be one of the biggest problems the world faces, is our pensions have been stolen. And the reason it's in trouble is because when we had defined benefit pension plans, if the government promised my dad $1,000 a month, they had to give him the $1,000 a month. And then something happened in 1974. It was called ERISA. And ERISA stands for Employee Retirement Income Security Act. And the government says income security, they're lying to you. And today it's called the 401k, the IRA, the Roth IRA, a SEP, Kios, and all this stuff. And when it shifted from defined benefit, which is a guaranteed set amount, and even like Ford Motor had defined benefit plans. So if I worked for Ford for, let's say, 30 years, I got guaranteed payment every month. Then in 74, it shifted to defined contribution. Those are massively different plans, but of course they don't tell you that in school. So when this gentleman said, "I've been driving the bus for 40-something years," he's about my age, "and I'm going to retire," I said, "Oh, do you have a government pension, defined benefit?" He says, "No, I have a 401k. I don't know if you listen to the Rich Dad program, but we dump all over that 401k because, in my opinion, it's not that it's bad, it's horrible. That's the problem with it, because if the stock market crashes, this bus driver who's about my age gets toasted. He gets wiped out because it's a defined contribution, not a defined benefit. And that's a very, very big difference." He says, "Don't worry." He says, "I know what you're saying, I know the stock market is way up there, so I shifted into safety." I said, "¿Qué pasa? What did you do?" He says, "I shifted into bonds." I went, "Oh." Because he drank the Kool-Aid that U.S. Treasuries or bonds are safe. And when I was a kid, that was true, but not anymore, because of the change from defined benefit to defined contribution, which took place in 1974. So we have we have a new apprentice at the Rich Dad company. His name is Spencer, and he's just turned 20. And, like the Rich Dad company was formed before he was born. And he's really young, in other words, and he's at university, he's Arizona State University, learning business and all this stuff. So when we hired him as my apprentice, the first thing his mother said to him was, "Be sure you get a 401k." Now, after I got finished vomiting, I said, I better say something, because I don't really talk. I talk about it in books and things like this, but never really address my concerns on that. So without financial education, the average employee or, a doctor or a lawyer who has a IRA or a SEP or a Roth IRA or a KEO, they don't know anything about investing. All they're doing is sipping on the Kool-Aid. So I want to show you why that bus driver, great guy, 40 years on the bus, he says, I moved to safety. So what happens here is the relationship, as you can see this chart here, you have bonds like U.S. Treasuries, and then you have stocks, something that's called equities. So what happened was when Nixon took the dollar off the gold standard in 71, remember 71 was Nixon taking the dollar off the gold standard. 72, Nixon went to China, which opened the door for Walmart shoppers and Amazon. And then all these things started to happen. So the U.S. economy started to sink because the Chinese were producing better products at better prices. And then a guy like Clinton opened the Chinese door to the WTO, the World Trade Organization. So when people wonder why I'm the most boring person on earth, that's what I think about. I go to parties and I sit there eating potato chips and drinking beer because I don't know what else to talk to people about. So I'm going to talk to you. So what happened when I was in my 20s, because the economy was stalling, they had to start dropping bond yields. So my numbers are probably off because I don't really like bonds. But let's say back when I was getting into the workforce, you could get 16% on a bond. So if you put $1 million or 100,000, whatever it was, you got 16% on your money. But as the economy slowed, they kept dropping the bond prices. They wanted to drop debt, make it cheaper. Then what happened is set the stock prices higher. So that's macro. That's the relationship between bond prices coming down and stock prices going up. So after 2008, what they call the GFC, the Great Financial Reset or whatever they call it, they had to keep dropping bond prices lower and lower and lower, and it got near zero. So they call it zero bound. So in some countries in Europe, if you have $1 million, you put it in a bank, they charge you money there's no interest in it. So that's why Rich Dad, Poor Dad came out in 1997. I said, savers are losers. The reason I said that was interest rates on your savings was going down. And they're printing more and more money on the macro level. And what happened is then these companies like the Fortune 500, they were borrowing cheap money to prop up their stocks. So they were buying back their stocks, which sent the stock price higher. So today, this is April 2021. The stock market is at an all-time high. Bond prices are about, I think the 10 years about 1.5%, so it came up just a little bit. This affects the whole economy. So when that bus driver said to me, he says, don't worry, I got out of stocks, I went into bonds. I said, I hope you like driving the Titanic because you're going to go down with it, And he got so angry at me because he did all the right things that his financial planner told him to do. And in a normal economy, that was smart because when I was a kid, only gamblers were in the stock market. You can tell Jim Records, who wrote Currency Wars and all that. He says Jim and I are about the same vintage. The only people that were in stock market were gamblers. Everybody else, back in my times in the 60s and 70s, were in bonds because they were really safe. So you could get that. And now it's like this. The problem is for that bus driver is this. If the bond prices go up again because they got too much inflation, I'm not saying it's going to happen. It's either going to inflation or deflation. We don't know. I don't know. But let's say they raise the bond price, stock market crashes, okay? Because the companies like Ford Motor Company, IBM, and those guys, the price of their debt goes higher. They're so deeply in debt because they've been borrowing from, let's say, IBM's treasury, and they've been buying back their stocks so their executives can parachute out with stock options. So the CEOs and the executives of these major corporations in America have been screwing everybody because they were borrowing money from the company to buy back the shares of their stock because the price of money was so cheap. But it drove the stock market to all-time high. So today, of the S&P 500, sort of the benchmark of how good the economy is, of the S&P 500, 100 or 20% of the S&P 500 are zombies. In other words, their debt is so high because their stock price is high, but they kept borrowing money to prop up the stock market. So what you're looking at here is kind of a mini, macro look at the world. So let's say they raise the bond price. Okay, so let's say they go from 1.5% to 3%. 100 companies crash. Of the Fortune 500, they crash because they can't make enough money to pay off the debt they borrowed. So their CEOs and executive vice presidents and all the investors can parachute out, screwing the stock people who invest in the stock market. That's why I don't own any stocks. I don't, because I'm an entrepreneur. I don't need to buy stocks because I can create my own assets. I create my own companies. I invest in private companies. These are public companies. So if you're understanding all that, there's public, private, there's stocks and bonds. So if they raise that up, this comes down. But guess what happens to bond prices if they raise the bond price? The bond price crashes. Because look at it this way, okay? Let's say I have a bond that's paying me 10%. Okay, and so they say, well, we need to goose the stock market, so they drop it to 5% interest. And so this bond goes up in value because it's paying 10%. So would you rather have a bond that pays you 10% or a bond that pays you 5%? I'll give you 4 hours to figure that one out, So they kept dropping it, and the price of the bonds kept going up because the interest rates were going down. At the same time, stock prices were going up. And now we're what they call near zero bound. How much more can they go? I don't know. I really don't know. Will they go lower? I don't know. Is there inflation or deflation? I don't know. But I'm just saying to you that that bus driver, if they raise interest rates on his bonds, not only does the stock market crash, but his bonds crash also. So he's following his financial advisor's advice, who, the reason they're called brokers, financial stock brokers, real estate brokers, is because they're broker than you are. They only make money if you sell you something. So they made a lot of money on that guy, trading him out of stocks and into bonds. They got commissions. But this guy is now skipper of the Titanic, and I don't know what's going to happen. I hope it all goes well for him. But if they raise bond prices, the value of his bonds crashes. So the reason I sit around and yak about gold, silver, crypto, Bitcoin, Ethereum, and all that is I simply don't trust the money markets or the stock market or the central bank. So that's why the Rich Dad Company was founded back in 1997 to educate people. So I trust you kind of understand this is really basic. They should teach you that in school. So when we come back, I'll be going into how this model here affects gold, silver, and Bitcoin. Okay, because we're all part of the same system. We're right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. Good news and bad news about money. And this is like a bonus event here. It's just me yakking to you. And it kind of explains why the Rich Dad Company was founded. Because as I've always asked, what does school teach you about money? And the answer is, what? Nothing. So you can listen to the Rich Dad Radio program anytime, anywhere on iTunes, Android, or YouTube. And all of our programs are archived at richdadradio.com. richdad.com, because if you listen to this again, you'll pick up twice as much. But more importantly, you can discuss this with friends, family members, and especially business friends, fellow entrepreneurs and things like this. Because they'll never teach you this. Wall Street will never teach you this. Your stockbroker won't teach you this. And your financial planner won't teach you this. That's why the Rich Dad Company was founded. So, Sarah, what was your question?
My question at break was, does the rule always hold true? If the stock market crashes, will the bond market price go up? Does it always hold true?
And that's the problem, is because nobody has that crystal ball. We can guess this and guess that. At Rich Dad, we're always studying something. Remember that we found out that quantitative easing doesn't mean they printed any money?
Yep.
That
they held it in that reserve account, and nobody can ever borrow. They don't actually get the cash.
No, there's no money entering the system.
Right.
But everybody thought, they printed money, so they expect stock prices to go higher and all that. So that's why I wrote my book, Capitalist Manifesto. And people say, why don't you invest in stocks? Because I don't have to. I'm an entrepreneur. I can create my own assets. I'm not saying you should do that. But with my Rich Dad, that's why I started, it was E, S, B, and I. My poor dad was employee or self-employed or small business owner. And there's big business owner and there's inside investor. So I'm a big entrepreneur. I have over 500 employees, multiple companies, but I invest from the inside. So if I ever I'll show it to you later. But the thing is, nobody knows, Sarah. Mm-hmm. So that bus driver, my age, his financial planner says bonds are safe. And I'm quite sure the financial planner means that, because that's what they're taught to sell you. But what is going to happen? Who knows? Who knows? This is the biggest bubble in world history. So it's either going to be the best of times or the worst of times. And that's what we thank for listening to Rich Dad. We have cash flow games and books and all this. We have real teachers, like my advisors, like Ken McElroy is really in real estate. We have Tom Realwright, who's a real tax guy. He's in, Garrett Sutton's in the law, and all that stuff. We're real. But none of us are giving advice. So we just had John Adams from Good Scholars Australia. He says, is it stagflation? Is it this? People don't know. But I want you to understand the relationship, this is macro, between stocks or equities and bonds. So this is cash, this is debt. You see, so if I have $1 million, I would put it in a bond and hopefully get 16%. That's safe as, if it's a U.S. Treasury, it's guaranteed. But to keep the stock market going up, they kept reducing so today I don't like bonds, so you can tell that. So don't take a word, don't listen to the word I say. But when that guy said to me, I shifted into bonds because they're safer, I'm going, oh my God. But that's the price of not knowing. When I tried to explain it to him, he got really angry. He says, are you a financial planner? I said, heavens no, I do have some self-respect, But that's why we have John McGregor and we have Andy Tanner as part of our advisors, because those guys are for real. They're in paper assets. And nobody has the answer, Sarah. That's what I'm trying to say. So if you're prepared for it. So if we could go into gold, silver, and crypto. Okay, so the question is, why hasn't gold gone up? Who knows where it's going to go? So I thought gold would be like $2,500 today, but it's $1,700. And the reason is when, it goes to the bond price went up, the price of gold came down. So they're all related, and nobody has an answer, but you got to pay attention to that. And then if you just listen to our Rich Dad radio show with John Adams from Go to School Australia, the Perth Mint is out of silver. Now, what does that mean? How could a mint be out of silver? How could a mint be out of gold? Because they're selling stuff they don't have. So that's corruption. So can I make a prediction? No. But that's why you got to be very, very careful. So the price of gold didn't go up. One reason is because crypto is, Bitcoin is sucking the air out of gold and silver. And the Bitcoin guys are going nuts. They're happy as Larry. Okay. So two things are affecting the price of gold. One is interest rates went up and Bitcoin came in, Ethereum and all those other things, which brings to my real rant is the thing I'm really upset about is I'm talking to that poor bus driver, and then I was talking to one of these young, what they call them, hodlers or something, this young guy who now he thinks he's Donald Trump of crypto or something. And so when Bitcoin dropped from, I think it was 65 down to 50 per coin, I bought more. And this Donald Trump of crypto is probably 22 years old, says, you made a mistake. You should have bought this. You should have bought that. You should have bought this. He started telling me about all these Doge coins or Kardashians or... I had no idea what the guy was talking. He says, Bitcoin's old. It's going to... The kid's a gambler. Not that I'm not gambling in crypto. I am not gambling in gold and silver. I've started gold mines and I've started silver mines. But let me explain this. The reason I'm in Bitcoin is because it's the most established. It already has a network. It's got a head start on everybody. So this guy is now, won't touch Bitcoin because he's chasing the next hot thing. Now, he's too young to remember pets.com and Amazon. Okay, do you remember Amazon was a struggling little company. They had no profits. And Bitcoin and pets.com had the sock puppet. And everybody was jumping up and down because the sock puppet was on Super Bowl and all this stuff. So all of these yo-yos chasing the sock puppet. And Amazon was the biggest thing going, but it wasn't turning a profit because they were reinvesting. They were doing, I don't especially care for Amazon, but they're doing the right thing. So they struggled. They kept reinvesting. I've met Jeff Bezos, because when Rich Dad, Poor Dad made the list, he invited me to their openings. He's a good guy. I just don't like the politics, if you know what I mean. Don't censor me. How dare you censor me? But other than that, that's the only bitch I have. So Amazon was the better buy, but everybody bought pets.com. And that's what's happening to, what else is going on? There's NFTs or something?
Oh, the non-fungible trades or tokens. Sorry. Yeah. But those are all just driven by speculation. Hype and speculation. Yeah.
Yeah. And so gold goes down and all you Bitcoin yodelers out there are hodlers.
It's the FOMO, fear of missing out. Everybody wants to get in because they don't want to be left out.
But all these young guys got their heads up their asses. That's the problem. They're not old like me and they don't have all the scars on their back to see the stupidity. They don't even know what the sock puppet was.
You know what I think is funny is that so a lot of people accuse you, you're old school because you're a gold guy. But there's a generation now, these 22-year-olds, who thinks Bitcoin's old school.
Yeah.
Isn't that how fast that technology moved, that mindset? Yeah.
And that's what happens, no basic financial education. Whether you're old or young, if you're stupid, you're stupid. Just don't worry about it. The market will take care of you. And the difference is that in my generation, it was real estate. So I took real estate courses. I've never lost money in real estate. I've made fortunes in it. Do you know? I'm an insider because I do all I don't touch REITs, REITs, real estate investment. I don't trust paper. I handle my own. I've started my own gold mine in China. Unfortunately, the Chinese took it. That was a lesson. And I started my own silver mine in Argentina. So I understand mining. So all of these guys, my friends who are in crypto, now tell me they expect about 15,000 new ICOs. So this, basically all it takes is a brain and some electricity and a computer, and you can create your own crypto. So could Bitcoin be toast also? Possibly. So when I told this guy I bought Bitcoin when it dropped from 65 to 50, he says it's going to go to $5. I said, it might. The difference is I can afford to lose that money. But that's called, I'm speculating. So this is, in my world as a professional investor, I'm in the acquisition phase. I'm taking a position. I've taken a position in Bitcoin and Ethereum. Every time it looks like it's getting a little cheaper, I'll buy it. I'll buy it. I'll buy it. So I saw Bitcoin at 20,000, I think it was, and it dropped to 7, and I waited. And when it came to 9, I bought. So today, let's say it's 50. I'm still in the money. And if it goes to 40, I'm going to buy more. Now, could I be wrong? Absolutely. Could some hodler coin take off? Yeah. Could there be another pets.com of crypto? Absolutely. But the difference is I'm in the acquisition. I've taken a position. I took a position in silver and gold. I have millions, not in this country. But I don't have any paper. I don't have any ETFs. I only take the real stuff. Because as I said, the Perth Mint can't deliver on silver. If a mint can't deliver on silver, who do you trust? And so with all of these young kids coming up going to invent the next Bitcoin, I don't doubt they will. I don't doubt one of those 10,000 new crypto may blow Bitcoin and Ethereum out of the water. And if that happens, I'll make my switch. But until then, I'm like I was with gold and silver. I'm in acquisition. I've taken a position. When I sell, it's called distribution. So as a professional, not a speculator, and I don't flip houses because I think that's really stupid because it's such high risk to flip a house. But today, everybody's flipping houses because the price of real estate is going through the roof. I was talking to the guy who cuts my hair. He says, I finally bought a house. I offered $100,000 over the price. I'm going, holy moly. It's a mania. There's booms, bust, and mania. Real estate is in a mania because of this. Because interest rates are so low, so not only are stocks going up, real estate's going up. And everybody's jumping in. When this happens, the idiots jump in. And that's what's happening right now. So Bitcoin is the same way. So when it took a dip, I bought more. Can it go lower? Yes, I'll buy more. But there's one big difference between Bitcoin and Ethereum and real estate. Bitcoin and Ethereum are liquid. Means I can get out. If I realize that there's a new NFC, what do they call them, or a new guy is going to take out Bitcoin, I can get out. But with real estate, the trouble with real estate, if it goes down, you're the skipper of the Titanic. You're going to ride that baby all the way down. So real estate is not liquid. At least stocks are liquid. But that poor bus driver dropped from liquid stocks into liquid bonds. He's got no place to go. So when I talked to him about possibly gold, silver, or crypto, no! He's an old guy, He's an old guy. So they're all related. So in this world of money, they're all related. It's like we're all related somehow on this whole planet. And so that's the world of money today. So that's real financial education. If you realize you cannot make a prediction, especially today, because nobody knows what's going to happen until it happens. The question is, are you prepared for when it happens? So I love Bitcoin because if I realize there's a hot new coin coming along, I can get out. But in real estate, I'm stuck in it. So those are some of the differences between investors, acquisition, taking a position, and distribution. I can distribute my Bitcoin and gold and silver quickly. I cannot distribute my real estate that quickly or my businesses. So those are some of the differences, and that's real financial education. So I thank you all for listening to my rant on this. But the reason I didn't buy the new hot coin is because I'd rather stick with the old coin called Bitcoin and Ethereum, because I'm an old guy and I like the fact that it's such a good, solid, more and more people are coming into Bitcoin. So could it be in a bubble? Yes. Can it go lower? Yes. But I don't chase the hot new thing. So thank you for listening to this edition of Rich Dad Radio. Any comments, Sarah, before we go?
So I appreciate you doing this episode because I think people like to hear directly from you. And this lesson was so simple and so clear. So I do encourage people to listen to it more than once because they'll pick up something new every time. But I think that your assessment of these new guys coming in with their cryptos is spot on because it's true. It's the same thing that happened in the .com bubble.
Yeah.
All these guys, we got to invest in this, and this, and look who's left standing.
Yeah. And people fail to remember, Apple, it's a FANG stocks, right? Facebook, Apple, Netflix,
Google.
Apple was toasted. It went down to like $18 a share because this corporate guy named Scully came over and they kicked Jobs out of Apple. And I didn't buy Apple at 18 just because I don't trust paper. Mm-hmm. Now, I'd be a lot richer had I bought Apple, but the reason I like real estate is I don't use my own money, I use debt.
Right.
So when the real estate market crashed in 2008, Ken McElroy and myself, we borrowed $300 million to buy real estate. You can't borrow $300 million to buy Bitcoin.
Can I ask you a question before we go? And maybe this is our next episode. Is, Biden just came out and they are talking about him raising his rates to 46%. Well, I saw a TikTok video where this guy's like, he can raise it to 100%, but because I'm in it for the cash flow, I don't invest for capital gains.
Right.
And really, that's what you and Kim do. You use the debt and then you get a tax break for using debt. I mean, we've talked. So really, that tax increase on capital gains doesn't affect you guys.
Capital gains affects you when you sell, and we never sell. In all my years of buying gold and silver, my mother spent my silver, unfortunately, when I was at school, which is why I was saying that's why she was poor. She didn't know real money from fake money. She didn't know real silver from fake silver. That was Gresham's law. Fake money drives out good money. And when 1964, they turned real silver into fake silver. And I started collecting in 1964 when I was 17. And I went away to school in New York and my mother spent it. That was one of the biggest wake calls of my life. I said the reason between rich people and poor people is they don't know real money from fake money. My mom and dad didn't. Good people, but they don't know that. So they spent it. And so today, I have millions and millions and millions in gold and silver. And I also use debt. I don't use money. And guys like Dave Ramsey say live debt-free. And for 99% of the people, that's good advice. Mm-hmm. But if you're going to be really rich, you have to learn how to use debt as money. But to do that, you got to be a lot smarter than some hodler, chasing Ethereum and all the other stuff. Okay? So that's what real financial education. I don't have an answer. I don't know what's going to happen in the future. Could my Bitcoin go to zero? Yes. But gold and silver have been here since the earth was formed. It's been gold, it's been money for about 12,000 years. Bitcoin has been money for 10. Now, does that mean I don't buy Bitcoin? No, I still will buy it, but I'll buy it because it's liquid. I can get out of it if I made a mistake.
What was it that Ron Paul said about gold? If you bury gold and you bury cash, because really, there's a lot you could, and you're going to, if you want to say the quote, that would be great.
Now, what Ron Paul was Senator Rand Paul's father. He was Congressman Paul. He ran for president, and he's a gold bug. And he said 200 years ago, if a Spanish galleon went down with gold on board, 200 years later, people are still diving for that gold, that treasure. Today, if a ship went down with dollars, nobody dived for it. It's not worth it. So that's the difference between gold and the U.S. dollar.
It's a great visual of
fake money versus real money.
Yep. Good.
Remember gold and silver? God's money. Bitcoin, Ethereum, people's money. And we still don't know. The jury is still out on both. So thank you for listening to this program.